I want to talk a little bit about portfolio construction here, because you point out in your notes that not all of your holdings in a dividend portfolio need to necessarily pay very high dividends. How do you pick and choose which stocks actually go into this ETF?
Yes, I think that's what unique about this income strategy. Typically, when someone crafted or constructed a portfolio with a tilt into income, all they care about is the dividend yield. In this case, we want to balance the income and the capital appreciation, which means that we believe that the sum of its part is better than the individual. And what that means is we're able to put in companies that has a higher capital appreciation, even though they're not paying a high dividend, and combine that with a company who may have a lower expectation of return with the one that is paying a higher dividend. So the combination of its part is the one that makes this one very effective. At the end of the day, this is maximizing yield per unit of active risk, right? Because we don't want to deviate too much from the benchmark that is benchmark against, whether that's a developed market, but also give you that extra tilt without sacrificing total performance.
And Dina, as I went over, this performance has been really good. So that obviously is going to help your case. But international ETFs, if you're in the US, haven't been that attractive to investors, even though many countries are hitting all-time highs. It's just not as good as the US. So it's been tough to get people to bite on the international part of this trade.
Correct, Eric. I mean, the story about international with the US being so strong the past few years, but I think it's probably now the time with international, and you can see it when you look at performances of last year, right? People tend to lump international as one, but if you look at single country, some country really perform strongly. For example, last year, Mexico was performing strongly. And then this year to date, Japan, especially the Japan hedge, has been performing strongly. Part of the reason why DIVI has been having the performances that you highlighted is because on top of the Novo Nordisk that you highlighted, it also has a few of the names that is helping in the artificial intelligence powering the longer term team. If you look at all the earnings call, you're hearing people are spending more and people trying to build the semiconductor chip manufacturing that's powering artificial intelligence behind that. But if you look at some of the individual names within DIVI, ASM Lithography, and then the Disco Advantest, they are companies that power that semiconductor ecosystem. Even though they are not particularly manufacturing the chip itself, they are the equipment that help build those manufacturing firms. So they are kind of like the beneficiary. Just if you look at the analogy, the automotive, the auto parts, semiconductor, this is the semiconductor equipment and tests that helps.
And I want to go back to sort of when you talk about where you add new holdings to this fund, because, I mean, we're just through the real heart of U.S. earnings season, and you saw a lot of companies come out and boost their dividends. How often do you rebalance? Do you add things? Do you take money, or not money, actual shares out of this ETF?
We do that on a quarterly basis. So on the quarterly basis, we're doing the rebalances to first look at companies that are adding dividend, as you said, but also balance that throughout. Because what's probably unique about this dividend strategy is the fact that we took a very conscious effort on the active risk, right? So which means we have constraint on the sector, on the country, as well as on the turnover itself, to make sure that it's delivering what we try in terms of the objective, maximizing yield per unit of active risk.
And if we look at the actual yield, the only thing that sticks out is this is only 10 basis points more yield than EFA, which would be sort of the bigger benchmark. That's 2.94%. Yours is 2.8%. Is that a challenge? Do you, to entice investors, do you need a little more juice than that?
I think our strategy when we come in with the ETF at Franklin Templeton is we want to kind of disrupt the industry, whether through a cost or through a performance or through a combination of both. So in this case, we offer investors, you get that tilt of income, but you don't have to pay that much extra for that. And I think that's the reason why we see the success of this strategy. This is one of those dream ETF where you actually see like organic growth. For like the past year and a half or so, we see creation almost on a daily basis. It's small, but it's growing, which just shows that it's truly organic. It's not just a handful of big investors, but there's a lot of people who like this strategy and
Right.
showing that by the activity of their flows.